I'm joined now by Evan Witkowski, member of the institutional client team. Together we'll be discussing both markets and Wespath fund performance. Welcome, Evan.
Thank you, Joe. I just want to kick it off with a real fun question, and it's fun for me. It may not be fun for you. But what had a lower correlation to the S&P 500 in 2024? Bitcoin or the U.S. Aggregate Fixed Income Index?
So I know the S&P 500 and Bitcoin both had very strong years, but I think you're trying to trick me, so I'm going to say the AG.
I tricked you. It is Bitcoin. Bitcoin had a lower correlation, believe it or not, in 2024.
All right, well, now I've got one for you. The S&P 500 closed near 6,000 in 2024. To start the year, what was the average Wall Street forecaster prediction?
It closed at 6,000. I'm going to go with about 5,400.
So 5,400 was the top guess. The average guess was roughly 4,860. So again, Wall Street failed to predict anywhere near where the actual returns were.
Wow, that's really interesting. Thank you for sharing. So, Joe, you wrote a blog in March about the Magnificent Seven stocks and whether we were in a bubble. You didn't think we were in a bubble at that time. What's your take now with the continued AI hype factoring in?
So what we were trying to say with the blog was we were comparing the Mag 7 to the dot-com era. In the dot-com era, where you saw these stocks push sharply higher, and we were saying that those companies were much less quality companies than the NVIDIAs and Amazons of the world that we have today. And since that blog was written, actually, the Mag 7 are up 50%, so I think I got that right. But at the same time, what we're trying to say is no matter how great a company is, there is a point where people will stop paying up for it. So we just haven't gotten there yet with the Mag 7. But something also to consider that we mentioned was that in the last 4 mega tech trends, which was PC, internet, mobile, and cloud, the market overestimates the short term and underestimates the long term, and that might well be what we're seeing with AI right now as well. But thinking back to forecasting and recaps, we don't like forecasting per se, but last year we did talk about the end of the rate hike cycle and what that means to an average 60-40 portfolio. And 1 year after the Fed stops hiking, you see an average return of 14%. So right now, the Fed has stopped hiking and the market's looking at potentially 1 or 2 cuts. But could we actually even see rate hikes in 2025, 2026?
Yeah, this is an interesting segue off of our discussion about forecasting. And as we both know, predictions can be futile as market conditions are constantly evolving. But as of right now, the markets don't appear to be pricing in a rate hike, which for me, I like to take the contrarian view, and I like to hope that somebody somewhere out there is going to price in a rate hike. The 10-year Treasury bond, though, is up 4.7% as of Tuesday, up to 4.7%, and inflation doesn't appear to be coming down anytime soon. The 10-year Treasury bond is also up another 1% since September when the Fed started cutting. This tells us, you and I both, how certain the Fed can sound, but when we got to future interest rates, they are just very much uncertain.
So let's switch gears and talk a little bit about equities. This slide is one that we've shown in the past, and it shows S&P concentration of the top 10 names in the index. As of November 30th, it's at 39%. So what can stop this U.S. concentration from continuing to rise?
Nothing, really. The U.S. stock market now is up to about 67% of the total market capitalization of the MSCI All Country World Index. Here's a promising indicator, though. Even though that's up about from 40% 15 years ago, since 1989, emerging markets have typically outperformed developed markets by 27% after a Fed rate cut, which the Fed, just as a reminder, initially cut rates in the current cycle in September of 2024.
So with Wespath performance, I mentioned earlier in a blog that the S&P 500 has only had 6 negative years of performance in the past 32. We've heard about the strong returns from the U.S. market this year, and according to the Wall Street Journal, the average U.S. stock fund returned 17.4%. The S&P 500 was up 25%, and the Russell 3000 was up 24%. How did Wespath perform in U.S. equities?
It was a tough year. We were slightly below the average active manager, which performed at 16.8% net of fees. Both the quarter and the year underperformed the Russell 3000. For 2024, 80% of managers underperformed the benchmark, which is the same as you noted in 2023. 2 years of underperformance for the market, but also for Wespath. Remember the concentration that I just noted in U.S. stocks?
And I'm thinking you're meaning that the only way to beat the index the past 2 years was to get even further concentrated in those top 10 names.
Exactly. To go that concentrated means you really have to make a bet to beat the past 2 years, which is why the majority of active managers underperformed. On a positive note, though, we did have an active manager that was up 37% for the year, outperforming that Russell 3000 we mentioned. One interesting name that they held was up 130% in 2024. But Joe, can you guess the name?
I actually can't.
Okay. Well, I've got it for you. It's Axon Enterprise. You may not have heard of it. I didn't know about it. It's a founder-led company. The company has been around for 32 years. It falls into the mid-cap growth segment of the market, which is not in that magnificent seven that we so often hear about. I also saw recently, though, that the Salesforce CEO, Mark Benioff, mentioned that the Magnificent Seven spending on artificial intelligence is only going to drive those companies' margins lower. Joe, does he have a point?
I have a few thoughts. First, I don't think we should expect big stock market gains year after year, especially after 2 years of 20%. Second, the earnings from mid and small cap are expected to grow and grow faster than the Mag 7 now in 2025. And then finally, U.S. small caps are the cheapest relative to large cap in terms of PE that they have been in 2 decades. So we would anticipate a broadening of the market rally to small and mid-cap stocks, to be fair, something we've been anticipating for some time. Lower inflation and lower rates would support a broadening of the equity rally, as would some kind of rollover of the earnings growth of the Mag 7. But let's shift gears again now and look at international. So in international, the U.S. equity market rallied after U.S. elections. But in international markets, they really got hit in the quarter after early November.
Yeah, it was a rough quarter. You're absolutely right. International was down 8%, giving up gains mostly on weak earnings growth. And then the second part of it was tariff talks. The dollar also appreciated 5% against a basket of foreign currencies, making the U.S. feel like a luxury good to foreign markets. And the analogy I like to use is a Hermes bag.
So our international fund gave up about 3% versus the benchmark. So what would you say to our clients about Wespath Performance International?
It's been an area we are working on with a lot of focus. For our clients, exposure to international is a part of any balanced portfolio today. We can't avoid it. An interesting thing playing out is that we've heard loads of negative news out of China. But remember when I asked you about correlations earlier?
Yeah.
There's an interesting story in China playing out. It's almost perfectly uncorrelated to the US in 2024, which means that prices are not moving in tandem, and we can reduce the risk by adding this asset to a broader portfolio. China is slightly above 8% in the benchmark. When you add in the benchmark's 14% exposure to Japan, the correlation here is still low compared to the US. This just tells me that there are great diversification benefits still available in the market. Although we do wish these areas were delivering better returns for our clients, it's an area we're watching close in 2025.
About fixed income, let's talk about that now. Let's show a slide on how interest rate shifts can impact the various styles within fixed income. Evan, what is this slide showing?
Off to the right, you can see that unless there is a rate rise, so hopefully I'm wrong, and hopefully nobody is out there forecasting that, which is the gray bars, fixed income is an appealing asset class with all the positive numbers. 2 of the most sensitive areas to loss are treasuries, which is where Wespath is underweight in our portfolio. If rates do go up, the good news is we would not be as negatively affected. But if rates come down, this could really spell for some good news going forward.
And then looking at our fixed income performance, our fixed income fund modestly underperformed the benchmark net of fees in Q4. What were the drivers?
Yeah, there were a few drivers. The alternatives in the portfolio, as well as the high yield, were the biggest contributors in the portfolio. Other strategies that outperformed the funds index were Wespath's proprietary positive social purpose lending program and agency commercial mortgage-backed securities.
And then on the full year, we outperformed by roughly 45 basis points. What helped Wespath there?
Similar story as the quarter. Alternatives was the strongest performing strategy for the year, followed by high yield. The overweight to high yield helped the most. The allocation to also the positive social purpose lending and agency commercial mortgage-backed securities also contributed. Finally, manager performance was beneficial, with 5 of the 9 strategies outperforming their respective benchmarks. There was meaningful outperformance of the Core Plus strategy, which beat its benchmark by 83 basis points.
And can you remind our viewers again, what does Core Plus mean?
You're really putting me on the spot here with this one. Well, core means that the benchmark invests in investment-grade securities such as government and corporate. These investment-grade issuances are rated by ratings agencies like Moody's and S&P. Our approach is like the benchmark, you could say, because the benchmark only invests in investment-grade and above. But the plus means our managers can invest in high yield and non-US dollar denominated bonds to achieve a greater return above the benchmark.
Got it. And let's talk now about the Inflation Protection Fund. What would you tell investors here?
We've got one really exciting change, which is that we made the addition of infrastructure, which is a lower correlated asset class to fixed income, kind of what we were talking about earlier with China. It's about a 2% commitment, so fairly small, and capital is waiting to be called, but I love the diversification and cannot wait to see this play out in our portfolio. In the fourth quarter, our commodities manager outperformed their index by roughly 0.5%. Ultimately, we outperformed by about 0.3%. Year to date, though, the fund underperformed by 0.9% net of fees. The allocation to emerging market inflation-linked bonds drove underperformance, as the benchmark no longer holds emerging markets.
And I should also point out that the Inflation Protection Fund is a diversifying asset. The Inflation Protection Fund returned 6% higher than traditional bond benchmarks in 2021 and 2022. So in years where we have unanticipated inflation, it does offer diversification and risk reduction. Okay, lastly, let's talk about the short-term investment fund.
Joe, I get made fun of because this is my favorite fund. What's your take on this fund now? Can I get some recognition that the fund is doing what it's supposed to do, which provides a low-risk yield like a money market fund to our clients?
Well, we'll give you some partial recognition. But the yield to worst does remain right in line with the Fed funds rate at 4.44% as of 12/31. So it's doing what it's supposed to do. That concludes this segment of the webinar. As always, we thank you for letting us share our thoughts on the markets and performance drivers. Our team is always here and happy to help you with questions that you may have. Thank you for joining, Evan.
Thank you.